Mason. Eleanor. Hello. Thank you. Shrikar.
Yes.
Eleanor. You need to see the resume. This was pretty good. There's some corrections. That was one. Then you were going to work on that.
Yeah.
And double check. I made some corrections to this. Let me see it after you're done.
Oh.
Okay. Okay. And let me see the memos here.
Oh, I have to do it.
Yeah, do some. Okay. Mason. Excellent. You just need to put the chapter presentation, which was the 3 slides per page with the notes.
Oh, okay.
Did I miss that? That was good. I did make some edits to the equity sub memo, so why don't you take a stab at it and let me see another, or actually yours was pretty good. Everybody else did something different. It was good if there's any corrections in that. So,
Cool.
you're really super close. Okay, and that was good. You probably want to see me. There's some corrections here. That was fine. Chapter presentation, I was looking for the...
With the notes, right? Yeah.
Yeah, the 3 slides. Then the homework, you have to add the websites. Just show me the printouts of the websites.
Okay.
Okay, and then did you write out the problems or did you do them all in Excel?
I did most of it on Excel.
Oh, perfect. Okay, and then the equity sim worksheet was missing, so I need the trades in the back.
Okay.
And then this was good. But always let me take it on and look at it too, so I can sign off on it. Okay? And then show me that stuff you need the original cover page.
Got it.
Jacob?
Yeah.
You ready, Ivan?
Yeah.
Ivan, what did you do first? You know, I'll work with people.
This is worth some work.
AMD's down to like $25. I'm probably down.
This is not a good time to join this game. Bad time for the
Speak really loud.
Right has this correction.
Yeah.
Try to wake them up a little bit. Okay, you're good.
Yep.
Okay, so this is the profit loss calculator that you guys will be using in this class. It's for when you guys do the moving averages. It's for the moving average part of the project, where you guys will try to monitor the moving averages to see when you buy and when you should sell. And this is an Excel where you just plug in the price you bought it for and the price you sold it for, and it will calculate how much money you've made for each buy and sell. And it'll calculate, there's a total of 10 trades per year, because you guys are probably doing 2 years. There's 10, 20, 30. And then all you have to do is just put the name of your stock, how many shares you bought, and then the top left cell is where you put the buy price, and the one right under it is the sell price. And it'll auto-calculate the total buy price of all the shares, all the total sell price of all the shares, and I'll give the profit or loss for each 2 transactions. And at the bottom, it'll give you the overall net profit loss, the annual average profit loss, and then the year 1, year 2, year 3 profit loss of all the stocks.
That's it?
Yeah.
That was easy. All right. Okay, cool. Thanks, Ivan. So I've already posted the updated worksheet up there. So he's added some more rows so that you can add more trades in there. So you're not limited to the trades. Okay, thanks. Okay, Lee. Where did you go? Kimberly.
Yeah.
So just like, do you want me to go now, Dr. Susan? Alright, so this is a pro forma that I did for my internship 2 years ago. It's more or less just they wanted to like make a cleaner Excel model, so I like did all this for valuing real estate. So these are all like for cash flow properties. This was specifically for like an apartment, but you could like do it for any other like office building or industrial or anything like that. Pretty much just like, you know, put in the price you acquired it for, you know, all these other things like due diligence costs and stuff. And then you like can make assumptions like using cap rates and stuff, kind of like with like the cash flow and the discount cash flows. And then like when you're planning on selling the property, you make these assumptions for like what selling conditions will look like for when you sell it. The company I was working with usually holds for about 5 years. So like when we did this, this is what the current like market was looking like 2 years ago. And then you do unleveraged analysis. So like if you weren't to take out any debt and you were just to use like capital from partners. So this is shows your returns if you didn't leverage any debt, so you didn't take out any loans. And then this is like just all the cash flow and income from the property and such. And then you have the levered, which actually in this case for this piece of property, it would have actually made, it didn't make sense to buy it at all because they both were losses, levered or unlevered, but being unlevered in this scenario or for this building was produced a better return, even though they both produced losses at this one time. And then this here is called the waterfall, and it explains how you pay out in a private equity scenario. So this was like for a private equity fund, and this like shows the amount that partners and investors will take over the course of years, and then the total returns. And then these are just some other assumptions that are made for like internal rate of return, which obviously it wasn't worth investing in because they all produced a loss. And then the cap rate is just what you use to calculate what the value of a building will be. So you take the net operating income and you divide it by a cap rate, and that tells you what the value of the building will be. And these are the percents that would have generated. And there's also these, which are mostly just kind of blank right now for the most part, but this is just like rental rolls and other things, like denoting how much like everything costs. So like from like landscaping and security and cleaning, all of that, the costs. And then this is where you would put like your rental comps, which then like ties into what the value of your building should be approximately, comparably. And then this is just your rent roll. So just, you know, how much you're generating from your tenants and what you can expect to get in income.
just show us the pro forma and the NPV.
Okay.
Do you calculate a cap rate over the holding period so you can see if we get to a hurdle rate in like 3 years? Something like that?
Just did assumptions for
Yeah,
cap
let me
rates
take
at the
let me
end.
take a quick look, because I'm trying to do two things at one time.
Okay.
Tyler. Oh, yeah, the equity for the SIU. Section, percent, you got it correct. You got it correct. And then you don't. Stay focused on the thing. So those are your assumptions right there. Where's the pro forma? Okay, right
The
there.
assumptions for,
And then do you show, do you show net operating income?
yeah, we do.
And then do you show, after tax, before tax, do you do those three scenarios?
Yeah,
With the
so,
ROE, IRR?
yeah, there's everything. So there's assumptions for acquiring, and then there's what you assume for financing, there's levered and unlevered, and then you have your exit assumptions, which this was what the projected cap rate was at 8%, but then you can also do it down here where you take like a multiple cap rates.
Now, do you calculate at the bottom of the pro forma where you have the NOI, do you calculate a cap rate over the holding period so we can see if we get to a hurdle rate by X date? Because sometimes when we buy these properties, you know, our cap rate hurdle's 5%. Does anybody know what a cap rate is? You guys know what a cap rate is? Okay, let me try that again. Do you know what a cap rate is? Okay, let me try that again. I'm just gonna keep asking questions until I get a response. I know it drives you crazy. Do you know what a cap rate is?
No.
No, okay. It's the net operating income divided by the sales price, or the value. It's gonna give you the income return. That's the cap rate. If my hurdle rate is 5% on the cap rate, but I don't get to 5% in year one, I'm gonna wanna know, as the net operating income grows due to either reduction in expenses or rising rents, when do I get to the hurdle rate? Does that make sense? Because you're gonna run the cap rate on the first year, right, stabilized income, right? What if your hurdle rate's 5% and you don't get there, you're at 4% or 4.5? The board's gonna wanna know, when do we get to our hurdle rate? Is it year 2 or year 3?
I don't think that was done because all of this was for add value, so the cap rates over the duration weren't as relevant because
Okay.
there was an expected exit at 5 years.
And then, is this a hypothetical underwriting?
Wait, no, this was for a real property.
Okay, and then what was the MPV on this? Under maybe one of your most likely scenarios or sensitivities? You're missing the accumulation, consolidation.
Yeah, so
And what was your IRR on this thing? What was the
IRR.
discount rate you were using?
Let's see, IRR is,
Do you have like an IRR grid,
I do have an
like
IRR.
an IRR matrix? And then what's the sensitivities based off of the discount rate or the growth rates?
No, it was based off of comparable sales.
Oh, okay. Okay, but did you run a sensitivity using different discount rates, or did they just say, okay, we want 14%?
I was just told what they wanted as a
And
percentage.
did you do a range of discount rates? Like
No,
discount
because
rate,
they
growth
were
rates?
pretty set on what they wanted as their rate, And so if they couldn't obtain that rate, then they didn't want to do it because of their like equity partner structure or something like that.
You may want to consider adding someplace in your worksheet the discount rate growth rate sensitivity in a grid format like you had before. Show me the grid that you have.
For the
The IRR.
IRR,
Yeah.
I have the IRR for the leverage and unleveraged, but
Yeah, but you didn't do it. What was your unleveraged IRR?
unleveraged, unleveraged IRR was a negative 0.48.
Oh, so you guys didn't do this?
No,
What was the problem? Was it the lack of rent growth or resale value on the back end of the pro
it was
forma? Or was
resale
because
value.
there's only-
Cap rates were expected to go up, but it was expected to stay, rentals were expected to stay consistent.
So basically, it was supply pressure on the growth rates and the resale value on the back end
Mhm.
that killed the deal.
Yeah.
Was it in a commodity market, like in Sacramento or Phoenix, or
No, this was in Seattle.
this was in Seattle? Okay, and then on this, the acquisition price also up front must have killed you pretty good, because the sales price per square feet up there is really high. Was this a apartment, industrial, retail? What was the product?
Yeah, this was apartments.
It was apartments?
Mhm.
And this was this an acquisition or new construction?
No, this was an acquisition.
It was an acquisition, and was the sales price per square foot pretty high on the upfront acquisition cost? Didn't that kill?
It was,
the
yeah,
deal
it was
too?
way overpriced.
Yeah, exactly. So you got killed on those sides.
Mhm.
And the expense structure is not gonna change. Your upfront acquisition cost isn't gonna change. Your resale on the terminal value is gonna be affected. And then where was the property located?
It's located in a town like just outside of Seattle, but it was like relatively like
Are we in
Close.
Bellevue, Tacoma, Everett?
Montlake Terrace.
Okay, is that north, south, east, is it near the airport?
No,
Am I
it's
asking
more,
too many questions?
No,
It's-
Montlake Terrace is one of the most wealthiest parts of Seattle.
Okay, is it on the north side, east side, west side? Obviously, it's not on the west
It's,
side.
it's near South Lake Union, so right next to all the tech hubs.
Perfect, okay. And then what about the supply issue? Was there new construction coming in within a 2 to 5 mile radius around the property within the next?
well,
5 to
everything
10
right
years?
now in Seattle is being
Everything.
developed, so there's a ton of supply, but
Okay,
it
and that was
mostly-
taken into consideration on the pro forma for lease up and rent concessions due
Yes.
to direct competition?
Mhm.
Okay, did you do a PowerPoint and present it to these guys, or just give it to them?
Nope, they didn't want a presentation, they just
Just
wanted
wanted to see what.
to do this. And then they ended up checking it, because they'd already ran this, but their, like, Excel was kinda getting, like, mixed up or stuff, because over time they'd been using it, so like,
Oh, it started to get corrupted. and
yeah, so I just, like,
reprogrammed.
did a new one, and on this one is the one they checked it against, because they already had one, they were pretty certain about this one done, so this is what they used.
Okay, cool. And then, how long did it take you to program this?
Like almost, maybe like 3 weeks.
3 weeks full-time?
Yeah,
Yeah, and you were working for them at the time?
yeah.
And were they happy with it?
Yeah, I think they still use it.
Yeah, good. And how many worksheets were there total?
Well, there's this one which is investment, and then this one just breaks down everything from, you know, like trash, storm, so it's all expenses, and then the comparables for rent, and then just right here, you can put in what your rent rolls for all the units on it are.
Okay, and this was an existing property, so had it been remodeled or repositioned or rehabbed?
No, I think it was built in like the 90s, and that's why they were interested in it as an add value.
Yeah, and how many units was it?
Almost 50.
50 units. And what was the vintage, what year was it
In
built?
the 90s,
The
early 90s, I think.
Okay. All right. And they couldn't get a price reduction? I said no.
But I'm sure they could have got a price reduction. I wasn't really involved in that at all. They were more just like considering this as a property and they wanted me to also like fix their Excel sheet too, so.
Did they actually make an offer on it?
No, because it
The
was,
selling was just too hostile,
well, no, it was just because both the leverage and unleveraged
just didn't work.
returns just made no sense.
Great, excellent, thank you. You guys can't have a copy of that worksheet. Right?
Yeah.
Thanks, Lee. Okay, so do you know what the next project is that you're working on? Do you know what you're working on next? These are just test questions to see if you're on top of it. Do you know what the next project you're working on? Two, what are we doing next? I'm testing you to see. There we go. So what are we working on next?
Moving average browser.
You can do that if you want to.
Real estate portfolio?
We're going to do some of that, but you should be working on the optimization. You just pretty much got done with the optimization. You should be working on the optimization worksheet. What do we need to do first for the optimization worksheet? What do we need to do first? Yeah, exactly. Get the data from NASDAQ and bring it into the worksheet for the 25 companies that you're tracking. So here's the worksheet. When you go up to NASDAQ and put it in, you got to make sure that you get the 5 years of daily data. Okay, 5 years of daily data. And then you're going to print it out. It's going to print to your desktop. It's going to come out in a raw form. And actually, I try to give you instructions throughout this whole thing. I spent a lot of time working on these things with instructions on where to go, how to get the data, how to put it in, that stuff. So this is what the raw data looks like. So you're going to get an Excel spreadsheet, and then you're going to take Apple, and you're going to paste it right here. Boom. And Apple has 5 years of data. So you're going to get the total return series right here. It'll calculate the mean and the median and the standard deviation right here. And then follow the procedures to be able to calculate the descriptive statistics so you can double check to make sure that there's internal validation to the mean, the medians, and the standard deviations. Then it's also going to calculate the histogram here for the distribution of the returns. Again, these are annualized returns on a 365 basis. So it's year over year, daily, 365. Okay? And then it calculates the returns for you. And it walks you through the procedures here on how to do the descriptive statistics. So once you fill in all of the 25 companies, then you're going to get this return series block right here. Okay. This is where you're going to run the data analysis off of. But unfortunately, some of you are probably going to be using mid-caps or maybe small-cap stocks in your portfolio, and you won't have 5 years of data. So you're going to have to go down to the row in which you have all of the returns and run the correlation coefficient on the data that you have available to you. So let's say I don't have, let's say I have Baidu.com right here. And I ran the correlation coefficient on Baidu and Facebook. Okay. So the correlation coefficient between Facebook and Baidu is 0.26. Well, that's not very strong. So let's say I don't have any, I don't have as much data for Baidu, but I do have a ton of data. Let's say, let's look at Baidu. Baidu is highly correlated, it looks like, with Facebook at 0.78. That's almost 0.8, almost 80% correlation between the rate of return on Baidu and Facebook. And it looks like to me that that's the highest one. So I would use Facebook's returns multiplied by the correlation coefficient between Facebook and Baidu to get Baidu's returns for the time periods in which you don't have any return series. So you're gonna have to use the correlation coefficient and look at the correlations between the stock that doesn't have all the data and the one that does have all the data, and look at the combinations and pick the one with the highest combination, but the other one has to have the 5 years of data. Then that's all you have to do is multiply the returns on the Facebook, multiplied by the correlation gives you the Baidu returns. Stick them in this worksheet back here. Right here. So you can just set up an equation right here and then plug in the rest of the returns. So you get a complete return series. Once you've done that for all of the stocks, you rerun the correlation coefficient and you check the correlations to make sure that they're stationary, that they continue to be valid, and they will be. Okay? Because the theory is that the correlations and the covariances are stationary when you have a large enough data set. Okay? Everybody follow along so far? Okay. Then, once you get the correlation matrix done and you filled in all the returns, then you can run the covariance matrix. Okay. Now you've got the covariance matrix. That's awesome. That's like one of the major hurdles to this whole thing. Then you're going to go to the portfolio optimization worksheet, and you're going to conduct some analysis, and you're going to plug in the 2018 returns. Okay. Based on the means and the medians or what you know, you should have been trading those stocks through your equity sim, so you should have a pretty good idea of what the fundamentals are and the technicals are for these stocks, and what you think the returns are going to be for all of 2018. We're kind of fitting the model. It really should be 2019 that we're doing, but I'm going to stick with 2018 just to be easy. So you already have pretty much the majority of 2018 returns for these stocks. If you know what the return was over the last 9 months, you divide it by 9, multiply it by 12, there you get a run rate. Okay, you get a run rate on the returns. Does everybody follow what I did? Okay. So once you put in the returns, boom, that's like the second big hurdle. This covariance matrix is just plug and play. You don't touch it. Do not touch it. Okay. And then this one here takes the max returns from this table up here. Takes the max returns, plugs in the min return, divides it by 15 to get the iterations, the return iterations. Okay. Then what you do is you plug, and it's going to plug in the return iterations here. Boom. So you don't want to touch that row. Then what you do is you basically link this cell to that. You're going to get the 22%. And then what you're going to do is you're going to run the solver, the first solver. You're going to run that. And that's going to give you, it's going to pump it out right here. You're going to get the results from the minimum variance portfolio optimization. Oh, I take that back. Sorry about that. The first optimization, you run the minimum variance portfolio, which is here, and it's going to pump it in right here. Then you copy all of that here and move it over and paste it there as a value. Okay? Don't paste it as an equation, paste it as a value. I'd be taking notes on this stuff. This stuff's pretty hard to follow. And then what you're going to do, after the first optimization, the second optimization is you're going to link this to that, and then you're going to run the second solver, the third step solver. What it's going to do is it's going to pump out this weighting scheme right here. Now the reason why it was 100% Apple and 0 everything else is Apple, I forecasted, will be the highest returning portfolio. So 100% in Apple and 0 across the other portfolios gives us this portfolio right here. This is the Apple. This is your first optimization portfolio. Okay. Then what you do is you take this right here, this part right here, you copy it and you paste it as a value right here. Don't screw this up right here, and don't screw this one up down here. Okay. And then what you do is you just keep linking this to that, run the optimization again, copy, paste it over. Link that to that, run the optimization, take these cells right here, paste them over as values, and you do it until you get all 15. So what you're doing is you're basically, and what will happen as you start to run the optimization, and you run these, so actually you're probably going this way, so you're going in this direction, you're tracing out the efficient frontier by return, and it's calculating through the covariance matrix and the optimization, it's calculating the portfolio standard deviation. Okay. So once you've got the 15 iterations done, then what you want to do is focus on the portfolio that gives you the highest return to risk, highest return to risk ratio, which is that one right there. Okay. And that one right here is that portfolio right there that is tangent to the capital allocation line and the efficient frontier. This all should make sense, make more sense now after I've explained it like 3-4 times. And then you've gone through the optimization chapters. Okay. So this is the target portfolio right here. The other portfolios down here are inefficient portfolios because you're getting less return and higher risk. These are the ones that you would be shorting theoretically. I didn't include that in there. So these are the feasible portfolios up here. And that's the one that we want right there. It's the one with the highest return to risk ratio. So you may need to change it may be this one, so you're going to have to change the color scheme. And then what I did was after I ran all of the optimizations, I went in and bolded all of the positives. So I had a nice spreadsheet, okay, to be able to, that somebody could look at very quickly. Then the last optimization here, and the instructions are all there, it should be fairly straightforward. The last optimization is going to calculate this capital allocation line right here, okay, which calculates this right there. So you may need to, we may need to play with the, basically the y-axis a little bit to get it to look like this. And then what you're going to do is you're going to take these allocations right here, and you're going to put them into your passive portfolio worksheet, and change the revenues and the market caps to replicate these weights. And then since you've already updated the passive portfolio, you not only have the back tests, but you have the forward tests too. Okay. And then what you're going to do is you're going to take your memo that you just did for the passive, you're going to correct that, reprint out the worksheets so that that's a standalone instrument. And then what you're going to do is you're going to print out and update the portfolio memo, and then print out the worksheets showing me that you've back tested and forward tested the portfolio. Use it this time using an active portfolio strategy as opposed to a passive portfolio strategy, and then produce that one for me too. Okay, and I would hand in both of them, so I can double check both of them. Because again, if your dates are off, or you don't have the formatting correct, or if you're missing the expected returns on the portfolio, or the formatting's not right, you can't give it to anybody. Because that's the first thing they're going to do is check for spelling errors, punctuation, if you're missing anything, if the worksheets are all messed up, they're going to be looking at that stuff. They want to find mistakes when they look at your stuff. Okay, they're looking for mistakes. Okay, all right. So that's the optimization. So I just wanted to go over that again. The other thing that was part of the issue, and how much time do I have left? 25 minutes. Part of the other issue was some of you weren't here on Friday, so I went over on Friday, but I'm going to have to go over it again because you guys weren't here on Friday. On the pre-test, 2 areas that were lacking some of the detail was the modern portfolio theory and the technical analysis. Okay, I would say most of the technical analyses that was conducted that you guys did. It's pretty good. A lot of you are missing this point right here. And you didn't have the head, and you didn't have the shoulders, and then what happens here, and then the breakouts to the downside. You have the support lines, you have the resistance lines, but you forgot to put out the breakouts. You didn't have anything here in most of the ones that I reviewed. And what is this phase right here? What is this? What is it?
The breakout phase?
Well, that's the breakout right there. Got it. What's this?
Trading
It's trading range. What else? What else is it called? What else is it called?
Support.
That's the support right there. And what's this right? What else is this called? That's right here.
Support.
That's the support right there.
Oh.
Horizontal trading.
No. Yep. And a lot of you in your memos, since you guys basically used all the same memo for the for your equity sim, you basically said that you were using fundamental and technical analysis in there, long, short, portfolio. Make sure in your rationales you're using a lot of this stuff. Okay? This is also called the consolidation. What you want to be doing is if you have your, you all have your deliverables in front of you, you should be making notes in the deliverable right now. Okay? Because my concern is that you're not going to be taking notes. A lot of you who were here on Friday did take notes, and thank you for doing that. But you shouldn't be sitting here, you know, just watching me. You should be correcting your stuff right now, okay, with either blue or red pens so that I can see that you're actually making the corrections. That's part of the test here, is to see how much attention to detail you have, okay? So consolidation phase. It's also called accumulation. There's your breakout. There's your secondary support. Here's your resistance. This is the first shoulder, this is the second shoulder, this is the head, this is the peak. You kind of bounced over here, broke out to the downside. You're going to see these patterns when you're analyzing your stocks. Okay, you got to be using technical and fundamental analysis. And you're going to see this pattern where basically it's going to break out and then it's going to start bouncing off this support here, which is going to be the resistance in the last historically. So it's forming a support right here at the prior resistance. And then, depending on what happens, it usually will break out to the downside here, and then actually what it'll do is it'll form another support here based on the prior support, and then if it's like, yeah, it'll break through and keep on going, and then you're worthless and you just lost all your money in some cases, depending on the stock that you're trading. So that was what I was looking for here. I think everybody got most of it, except for this. In the portfolio analysis, the modern portfolio analysis piece, some people didn't even go to the origin to put in the risk-free rate. Some of them, your efficient frontiers weren't even tangent to the capital allocation line. I mean, I always see stuff like this, you know, just like that. Okay. Or I see stuff like this, which is not an efficient frontier. Just, you guys are just scribbling stuff. You're not even thinking about it. You're trying to get it done too quick. There's a way to actually draw these things. A lot of you didn't have the market basket. A lot of you didn't even have the utility curves. Or you had some of them, but they were kind of weird. Some of you didn't even have the portfolio standard deviation or the expected return on the portfolio. had some kind of efficient frontier. I was looking for feasible points, so that you didn't even have the 100% bond or the 100% stock. And we didn't have any lines in here. Again, detail these things. Expected return bonds. I would say most of you didn't have, which is they're two of the most important aspects of this whole exercise. What happens to the efficient frontier when you add alternative assets to a stock bond portfolio? Okay, first question. Do alternative assets such as insurance, real estate, and alternative energy, do they have high, low, no, or negative correlation with stocks and bonds? You guys all want to, everybody tells me I want to be an equity analyst, I want to be a portfolio manager. Well, this is the theoretical constructs around being a portfolio manager. This is the simple theory piece. So does alternative assets, such as insurance, real estate, and renewable energy, do they have positive, low, no, or negative correlation with stock bond returns?
No or low or negative.
What?
Like low, no, or negative.
Exactly, low, no, or negative. So would you get diversification by adding those alternative assets into a stock bond portfolio? Yes. And if you did add those assets into a stock bond portfolio, what would happen to the efficient frontier? This is the most important part. What would happen?
It would bow out.
It would bow out. That's exactly what I'm looking for. Okay? That's exactly what I'm, so the first thing I do is I look to see if you've bowed out the efficient frontier. It's the first place I go. Okay? So if I bow out the efficient frontier by adding alternative renewable energy and insurance to the portfolio, what happens to the expected return on the portfolio? What happens to the expected return when the efficient frontier bows out? What happens to the expected return? No, no. What? Goes down. Got it. And what happens to the portfolio? This is what you were thinking about, Jason. What happens to the portfolio standard deviation? Hold on, I add in, it goes it out, the return goes down, and the risk goes down. Got it. Okay, this is what I'm looking for. Okay, it goes down. So this is going to be my portfolio. Adding the alts in there. This is my star portfolio right there. You can have that over here. What's this portfolio right here? Or actually, let's do this one. This one right here. What's the equation for that? What's the equation? What do I care about? In these portfolios, there's only two variables.
It's the expected rate
My expected return, got it.
and your CAL.
And my portfolio standard deviation, got it. And what's that called? What's this called? When I divide the expected return by the standard deviation? My risk adjusted rate of return. Got it. And if I add alternative assets to the stock bond portfolio that have low, no, and negative correlation with each other, and it bows out the efficient frontier, what happens to the expected return? Goes down. What happens to the portfolio standard deviation? Sorry, I did it the wrong way. What happens to the expected return? Goes down. What happens to the portfolio standard deviation? Goes down even more. And what happens to the risk adjusted rate of return? Goes up. And if I can get my clients an 8 to 10% annual rate of return, this is my expected return. Portfolio, what happens to the portfolio assets? Yeah, but what happens to them? If I can get them 8 to 10 rate of return on the portfolio, what happens to the assets in the portfolio? In less than 10 years.
Oh.
Okay. So if I can get my clients an 8 to 10% rate of return, expect a return, I can double the size of the portfolio in less than 10 years. If I add alternative assets to the portfolio that have low, no, and negative correlation with the stock and bond, with the stocks and bonds in there, it bows out the efficient frontier. Yes, the expected return goes down, but the portfolio standard deviation goes down even more, and the risk-adjusted rate of return goes up. Okay, that's huge. Great. That's what we're all trying to do. And then the last piece is the life insurance. Okay, I'm working with high net worth individuals, principals of major corporations, people that have family offices. If any one of those individuals, both the corporate leader or the head of the family, something happens to them, the portfolio could be destroyed and will definitely be impaired for some time, okay, because they're the human capital, they're the human equity within the portfolio. But by having the insurance, the life insurance as part of the portfolio, if the principal passes away, the estate is injected with a death benefit that jacks the expected return on the portfolio and actually moves the estate onto a higher utility curve, which is where they wanted to be in the first place. They wanted high return at a given level of risk. There's no feasible portfolios out there. That's why the risk-averse investors had to lower their utility to the point of the market basket, the tangency of the utility curve to the capital allocation line, to the efficient frontier, to basically invest in the market basket. And we know what the market basket allocation is, don't we? In the early period, you know, in the 20s to 50s, the allocation was 70% bonds, 30% stock. This was like the 20s to the 70s. And then in the 80s, the allocation changed because Ibbotson did the research, recommended a 60% bond allocation, 30% stock, and 10% real estate allocation. And then in the 90s, Ibbotson did more research, same analytics, said we should take down the bond portion to 50, keep the 30% allocation to stock, invest 10% in direct real estate, and another 10% should be allocated to cash value life insurance. And then in 2005, no, actually it was 2009 when I started to work on it, in the 2000s, it wasn't Ibbotson, it was a Deutsche Bank Reef did the analytics on this too, and said we should take, again, from the bond portfolio, have 40% in bonds, keep the 30% allocation to stock, keep the 10% allocation to real estate, keep the 10% allocation to life insurance, and add another asset class called alternative renewable energy. This allocation right here, this is your model. This is the model where your target portfolio for the next 30 to 40 years. This is your allocation. These were my allocations. I wasn't even born yet here. But the market basket, which is basically just an index, a multi-asset portfolio index, shifts over time as new asset classes are introduced into the capital markets. And over the last, I would say real estate really came in the 80s as one of the first alternative asset classes that was institutionalized. And actually, cash value life insurance had been around for a long time too, but it hadn't been institutionalized yet. So it became, even though it had been around for 150 years, it was reintroduced into the marketplace for institutional investors to participate in the cash value life insurance policy pools. And then the alternative renewable energy keeps being validated every single day. I mean, Jerry Brown basically stated that alternative renewable energy, that we would be sourcing all of our energy from alternative renewable sources within the next 40 years, which again, from a policy standpoint, confirms this allocation for you going forward. So you'll get diversification through the alternatives. It'll mitigate the volatility in the stock and bond area. Unfortunately, these are highly illiquid, and this one's undeveloped as a capital market for you to expose to. But over the next 40 years, this, in my view, will be the target model portfolio that you will use to allocate to. Okay? And most institutional investors will probably target this allocation also.
So like going off that, what instruments would you suggest we use?
Over
for,
here,
yeah.
for these. Well, the institutional investors can co-invest with large utilities, okay, and put up the equity to build the renewable energy plants. So they'll put in the equity. So if it's $1 billion plant, maybe they put in 250 million, you know, something like that. So you can raise the capital from multiple institutional investors. The question is, how do we participate as retail investors in this space? It's really super hard. There's publicly traded solar companies. There's really no biogas. I can't really buy into a publicly traded, water, hydro plants, portfolio of hydro plants. I can't invest in that. I can't invest in biogas. I can't invest in a geothermal. So there needs to be an introduction of new publicly traded and privately traded companies that will provide vehicles and tools and investments for retail investors to participate in this space. It hasn't been invented yet. You have to invent it. You guys have to do it. Okay? I've tried to do it with some success, and I'm going to meet with my partner today. We're going to go over this stuff. This is exactly the stuff that I've designed to be sold to institutional investors to justify the allocation, particularly not only to this asset class, the real estate. Life insurance is a little hard, is another hard one to expose to. We did start to develop some product in this area, but it had a setback due to some unscrupulous individuals within the space that kind of tarnished the reputation. So that was kind of impaired, but this one has potential to develop. And we're talking about a multi-trillion-dollar market, that could potentially emerge with investments in alternative renewable assets. The problem too is that under the Trump administration and the prior Republican Congresses, in 2009, there was an alignment of cap and trade. We had the Kyoto Treaty, which was global. We had cap and trade at the US level. We had AB 32 at the state level, and we had community choice aggregation at the city level. So there was a period there where there was an alignment of policy that would basically have set up a framework to channel trillions of dollars into alternative renewable energy. But the Republicans killed the cap and trade at the US level, sabotaged Kyoto at the global level. AB 32 is still in place at the state level, and then the community choice aggregation at the city and county level that we bid on and actually won that and was going to run the utility for the city and county of San Francisco. That got killed by PG&E and Shell. They came in and they took us out because they saw what we were doing, and they never developed it. So there's policy and industrial structures that you have to deal with when you're, and this is highly politicized and there's a lot of policy around this, but I think there's a huge opportunity here for growth if you're interested in sustainable renewable energy as a space to dedicate yourself to. Okay, yeah?
For the efficient frontier, how do you show the negative risk?
Okay, perfect. Thank you for saying that. It's pretty much the same thing. But what I was looking for was, can you rudimentary replicate this, this graph, and then basically, if you want to show it on the same graph, add in the negative risk-free piece, and then you basically do this, this, and this is a pretty important piece because I would say at least 30 to 40% of the globe currently is under negative interest rate policy, still at this late stage of the economic and credit cycle. So what I'm looking for there is, do you understand that the expected return goes down when you drive interest rates negative? Okay? And if you're using the Gordon growth model, cash flow T+1, and a lot of you were using, when you were doing your intrinsic valuation models, along with the multiple model and the intrinsic models, you were showing me dividends, or Ds, but you weren't showing me that it was D+1. It wasn't dividends next year. You were showing me dividends as this year. When you value a stock, you're not using this year or last year's, you're using next year's. So you need that T+1 in there. And this is I minus G equals the value using Gordon growth. So if my expected returns are being driven down by negative interest rate regimes by the central banks, what happens to the value of the stocks? They go up. So basically central banks, by using negative interest rate policy, are able to prop up stock prices to keep the wealth effect in place. Because if people see their stock portfolios go down significantly, then they're not going to feel the wealth effect, they're not going to consume, they're not going to invest, and the economy is going to go into a recession or a severe recession or even a depression that could occur. So by driving these interest rates negative, it brings down the expected return on the portfolio and props up the stock prices through monetary policy. And most of the, a lot of the central banks in Japan and Europe are still in a negative interest rate environment. But that's important. When I was teaching this years ago, we were never in a negative interest rate environment. It was only until the last financial crisis that we had to add in negative interest rate policies into the finance models to update them to make them more relevant. Or I could have just been teaching you just static, models that didn't even take into consideration the dynamics of the current environment. And right now, these are starting to move up. Right? These are now starting to move up because the Fed's unwinding the balance sheet. Okay, and then some of you too in the pre-test, you didn't have the you didn't list any numbers for the stock market, the bond market, no yields, no current stock, no oil prices, no current gold prices, no dollar to the pound, dollar to the euro. There was no detail in there. So what was missing was really the technical analysis and the detail of this. And then I was looking for some other details. Okay. And if you had taken 123, then you should have gotten most of it. Some of you didn't even do the supply-demand dynamics. The shifting back and shifting out of the supply curve, or up or back of the demand curve for the different asset classes, with the reasons why it would shift the supply curve back and out, and the demand curve up and down. So I was looking for those too. If you want, I can go over those, continue to spend a little time per class to reinforce these concepts, okay? Because these are the underlying foundational concepts. That pre-test was really important to refresh your concepts, but also to ground your analysis and fundamentals. Anybody else have any questions on the deliverable or anything? Okay, did everybody pick up their problems? Okay, and then I think there was somebody, a team that wasn't here, or maybe there's other teams that had not shown up that may still owe a chapter presentation.
Yeah, we're gonna go on Friday.
Okay, so how many presentations do we have on Friday? We should have at least 3. Did you? I think, wasn't there somebody not here on Friday? A team that was supposed to present that didn't present? Okay, and then we have 2 more chapter presentations, so there's 3. So who are the 3 teams that are presenting? And I did hand out notes on Friday, a schedule that basically lays out all the expectations for the midterm. You maybe want to pick up some of the stuff that I gave out. It's over there. And if you have your deliverable, you can put it here. then Eric, did you need the other two
Yeah.
sections for the mentor?
Yeah.
Or the quiz, sorry.
Pretty good.
And the S curves look like this. S curves look like this, not like this. It's not an S curve. S curves look like
They
that.
got met him once before. Yeah. That's what he forgot about. They brought going over there.
Those are S curves, everybody.
A while ago.
A lot of these are what S curves look like. They don't look like that. They don't look like that. And usable orders. And then you got to put in the ones. That's always the problem. Just a little one. And then you have a template. And you have a template. So any of the reworks, and then you have and then I'll just check.
He asked me about
Yeah.
Some stuff. I don't know. I can't read them. They like farmer sales. I don't know if he just has nothing better to do or if he actually like.
That's okay. That's okay. There's a lot of them. Okay, cool. Awesome. If you want me to take a look at it before you hand it in, I can make some comments. And then you can just text it.
I can probably come in,
Yeah. Yeah, come come at 11. Yeah, and then we'll spend like 10 minutes on just, and then you can take it. Okay.
Perfect, see you then. Thank you.
When can we meet for the rest of it?
Anytime. I'm good in the mornings before the class, unless you have a class.
I do have one.
I usually get here at like 7:30. Or right after class. We could do it like right after class.
Let's do that Friday.
Yeah. Let's see, am I doing it on Friday? Yeah, I can do it on Friday. Yeah. All right.
Fred, do you think we're going to a recession?
Not yet.
Not yet?
Yeah, it's not